Here we are in 2026. Some people might think predictably, but here we are in Iran dealing with that. We've got a new Fed chief coming in here in May, I believe. And does anybody really believe that we're going to raise rates with him coming in? So you've got that. And then you've got kind of this whole background, this whole backdrop, rather, with what's going on in private credit. And, there's an article this morning in Wall Street that, a lot of these companies have, there's not really a standard way to do it, but it sounds like a lot of them have a lot more exposure to software than they might have let on. So, kind of weave that together, Brian, and kind of talk about where we are right now and kind of what you see going forward here for the balance of the year, kind of given what you've shared with us thus far.
Sure. I would before the 28th of February, right? I thought that we'd seen the highs for the year in the 10-year, and then obviously after the 28th and after everything started, it almost became this all bets are off sort of thing. And I think about about 2 weekends ago, I saw a poster say that you should take all your money out of banks, that you should buy staples and dry goods and all this stuff because there would be no access to your money, and the war and the conflict was going to just lead to so much more. And it brought me back to a point during COVID where someone had written that the mortgages that we all use for homes, or that people use, that the banking system, everything was going to collapse, and that nothing would be tracked anymore. Everything would be worthless, and there would be no tracking of anything because of the decimation that was going to occur in the banking and the financial system because of COVID. And so,
Right.
kind of looking at those things in parallel, I just thought, there's that kind of peak that you're looking for, where people are just immensely extrapolating and really overreacting. And I made a couple of LinkedIn posts about this idea that having to fight higher oil prices with a hike it was starting to get a little out of hand. Earlier in the year, we'd had 2 cuts built in, and maybe that was a little too rosy, or however people looked at it. But then to kind of suddenly switch to now this higher oil price is going to start hurting everybody. So what's our response going to be? It's going to be to hike rates. I get it from the sense of the traditional response to inflation, but it just didn't make sense in the context of what everyone has been talking about now, or had been talking about leading up to that. So yesterday, we started to see a little bit of relief from that idea of hikes, right? People got more along the lines of, okay, we're going to be just kind of unchanged, or maybe even lean towards a cut. It's hard to think of a cut at this point because of higher oil prices. But, I don't know. I think this might be a little bit of a contrarian or a non-popular view. But, Myron was still out there talking about the room that there is to cut. Not necessarily saying that he's pounding the table. I think he's certainly been on that side and made it clear. But, he's not saying like everyone's crazy for not doing this or anything like that. I think he's just saying that there's a lot still room for a cut. And Warsh, again, as we discussed, he was kind of brought in with that in mind, not because he's going to rubber stamp a cut, but because at least he is going to be aligned with this administration's view on where rates should be. And so I still think that there's a lot of room for that to occur. A lot is going to be determined based on how things unfold from this conflict and how oil prices go, the whole thing, right? But even this morning, as we start seeing news that it might be resolving, that the different scenarios in which the U.S. could stop military activity, and the strait could be closed or temporarily closed in Iran. A lot of that will be kind of determined on how they unfold, or how things go that way. But there's a lot more almost kind of hope, or at least that view in the market, that it's kind of winding up. And in my mind, a lot of things are going to snap back to where they were, or at least snap back to the trajectory and the path that we thought they were before February 28th, right? It doesn't mean that oil is going to go, suddenly it's going to be $60 a barrel or anything like that. It just means that the path that we were progressing on and the way that things were shaping up will be able to resume, and I think even the market broadly looked at this as more of a temporary thing. It's true that stocks took it on the chin. We got into corrective territory, all those sorts of things, that the highs in the 10-year that I'd mentioned, right? We surpassed those. And so we got to higher levels. But all told, I wouldn't say that things spun out of control almost as dramatically as you might have thought. We had nothing like the response we saw in COVID, where things were uncertain and we didn't know how to deal with this new strain or anything like that. And so I felt like the way that the markets kind of behaved was almost like a controlled pushback, right? Or controlled chaos probably isn't the right word, but something along those lines. And so I think we're going to be able to see a lot of things, hopefully anyway, resume after things are a little bit more settled from here. Even.
Well, I continue to think, Brian, that I mean our portfolio continues to be in great shape. I mean, we've got a borrower that has an asset that they have 60%, north of 60% equity in, that these bonds are trading in the low to mid 80s. And, as you just talked about with excess spread, a lot of these things can mature above par. And so I don't know what else is out there
Yeah.
that, I
Well,
mean,
you'd
this
also
is this
mentioned,
is something that everybody we believe ought to have a little bit of in their portfolio, particularly when you look at what's going on in this private credit space.
yeah,
So
I'm sorry, you'd mentioned that earlier too. And I think that private credit, I'm hopeful, and I think the broader market too is looking at it as something that's going to be a little bit specified to that space. Fortunately or hopefully, it will not be just a contagion like we saw in the GFC. But I do think that there are definitely issues there or things that'll have to be worked out, whether it's just the fact that they need the time and some of these funds, the way they're set up, are a little bit more gated, or they have this kind of interval feature. Some of
right.
that stuff is going to cause some issues. And so, it will be handled the way it needs to be, as markets always take care of. But as you said, I'm glad that the things that we own and the things that this kind of tangible asset idea and the seasoning and all that stuff is really supportive to the bond securities, and they've held up pretty well, even in the last month during all the volatility.
Great. Brian, let's leave it there for now. I'm sure there'll be a lot more things that we can come back with you on. So thanks for joining us. Until next time, I'm Mike Flaherty. Goal line 9.